the annual report is out this week. I've asked the team to put the link on there, so if you want to have a little look at that report, it tells you.
One of the things that we get quite a lot as advisors is, should I be de-risking the investments? What should I be doing in this sort of situation? Well,
speaking to a financial advisor and you're doing probably the most basic thing, which is when you're completing the fact find, is your income and your expenditure. It really makes people think.
The key things here is making sure you're in a good fund, and then you're in the right products as well,
Yeah.
and also just looking at what your disposable income is.
Good morning, afternoon, or whenever you're watching this podcast. Welcome to episode 117. And apparently I've got to say this, I can't believe we're at 117. But the title today is Why Financial Advice Matters to Your Money. And we've got sort of three excellent guests today, all qualified financial advisors in the room.
Correct,
today.
yeah.
I think we are. So got both four advisors to sort of discuss in a bit of detail. You probably recognise Neil on your... How many appearances now? Too many?
A lot, yeah.
A lot.
Good morning.
And Tom's on his second appearance.
Yeah.
And Helen, welcome, your first appearance. I think
Thank you.
Pete asks us to always do something at the start, which is tell us something new about yourself that you've done this week.
Well, so I knew I was coming on the podcast actually, so I thought I'm going to have to do something new. So I decided to wallpaper.
Oh,
And very,
Please
very
balls, man.
exciting. Yeah, very exciting. But it was a complete disaster.
Oh.
So never again. So thank you, podcast, for ruining my walls.
I don't think I've ever actually wallpapered before. I don't know.
Well, I hadn't either. That's the thing. I thought,
Ah.
something new to do, DIY, and it didn't go well.
No, it's not a less than
Not
my
a
life.
forte of mine, definitely not.
I've tried to hang a shelf before and it fell down, so never again since. So,
Yeah.
well, welcome. Hopefully, you'll enjoy today. It should be a good session. And we're really talking about today about like why financial advice sort of matters to your money. Specifically, I think for me, I'm trying to get across to our viewers of when you should take financial advice. And I think Tom, we'll start off with you in terms of just give me a little bit on how you become an advisor at True Potential, and it's worth just letting people know of actually how do you become an advisor. What have you had to study to get these qualifications to?
Yeah. Well, so I started off my background. Obviously, I went to university, came out of university for business degree, and then and this was my first job was True Potential, and I actually worked in the marketing department here for a year or so, and then I realised I wanted to go into the sort of financial advice arm really, and we have a really good graduate sort of program here, which obviously you both set up. And so I did my exams within 6 months, which is quite a short period of time, really. Normally it takes a bit longer than that, but thankfully we had time off to study, and then did a year in compliance, and then, from that point onwards in compliance, you're sort of looking over what other advisors do and what their cases are like. And then went into the financial advice team, and obviously I've been there for 2.5 years now, so it's been quite a long journey, really. Looking back to all of that.
I think it's actually quite an interesting one because we've all did different roles in True Potential, and it is you can start in one area, which is marketing, which is nothing to do with the advice side of the business, and being able to start to study. Just going a little bit on your exams. So what do you have to study in terms of the 6 exams?
Yeah, so there's 2 different exam boards really. There's the LIBF, which is obviously what you three have done, and then there's the CII one, which I've done. Both are very, very good, exam boards, but a little bit different, I suppose. I mean, with the CII ones, you do 6 exams, which goes from hour 1 to hour 6. And then after that, obviously, you'll just keep doing more and more exams, unfortunately. It's been a bit of my life the last sort of 2.5 years. But, it's a really good thing because you can sort of develop, even when you've qualified, you can still keep developing and do more and more exams. And I think, since, the retail distribution review came in 2012, all advisors now have to be level 4 qualified, which means you get a good quality of advice now. Not that you didn't used to get that in the past, but the sort of the boundaries have gone up a little bit, than what they used to be.
And I think as well, probably more important as well, is it's great to pass the exams and get it under your belt, but also the experience is worth probably a little bit more. So having Tom training in the role, and then also him obviously qualified as well once he passed through the graduate scheme, has obviously had its great effects on obviously where he is now. And I think to be quite fair, 2.5 years is it can be classed as a long time, but realistically in your career it's quite a short time. And he's done quite well in that time.
I think it's we've always tried to increase and educate staff that come into TP in terms of how to get them better qualifications and improve it. Actually, all of this sort of thing helps our end clients in terms of having more advisors that have kind of come through the company, etc. And when we do,
well, there's not a lot of young people
Yeah.
as financial advisors in the industry, so that's what we're trying to sort of change, if you like.
Yeah, no, I totally agree.
I don't think that's a bad thing either. I think like even people might think, oh well, you're young, you might not know as much, but I think the younger advisors are all quite hungry to learn more and do more exams. Maybe than somebody who's potentially retiring as much. You don't need to really push themselves as much. So I do think that sort of youth isn't a bad thing, to be honest.
Yeah. And I think probably just add into that with there's many things that we do with True Potential. The annual report is out this week. I've asked the team to put the link on there. So if you want to have a little look at that report, it tells you. There's actually quite some nice things in that. It tells you about our results and the profitability of the business and how we've kind of grown over the last sort of 12 to 18 months. But actually there's some good areas in there about charitable things, the academy stuff, etc. So have a read of that. There's a link coming on the screen now, so please have a little sort of read of that. And the other plug we should probably just get out is the morning markets. I know it's probably remiss before we go into the full topic is to talk a little bit about the markets, because it's been a bit of a bobbly week again. But I read a couple of stats on sort of yesterday in terms of some companies like Apple, where Apple dropped 8% in a week. I think this is actually quite important. When we talk about staying on over long-term investment, do we think Apple are going to grow in the next 2 to 3 years? I think it's probably a good question for the audience. I think the answer to that's probably yes. I don't know, Neil, if you want to elaborate.
Yeah, I mean, I had I've been having conversations with clients this week over the markets and also what's going on in the world. I think if you switch your TV on, you sort of compounded with bad news at this moment in time about the cost of living, the cost of fuel, Russia, Ukraine, and it's all sort of creating a little bit of a mini storm, if you like, in the investment world. But it's very true to say that you should always view your investment goals as medium to long term. If somebody said, I want to put some money away for 6 months and I want it in 6 months' time, we probably would say, well, no, that's not right for you. Okay, you need to be viewing it for a medium to long term, and most people do. They have medium to long term goals.
And I think that's my point about taking the Apple stock in a sort of isolation, because there's within your portfolio you've got a vast array of different equities. But you're taking that as an example. Is yes, you've got this little bit of a sort of bobbly period at the minute, but over that long-term period, which is what we talk about investing as a long-term period, these are good sort of profitable businesses that are just having a little bit of a short-term shock by what's going on in the current sort of environment.
Yeah, I think diversification is a good question to really bring up there, and with clients and asset allocation when we talk about the portforios, just to mention Apple as a stock. We don't just hold a lot of shares in Apple in your portfolio. We spread it right across the investment amount, and it's really important to get that message across to clients. We always say, don't put all your eggs in one basket, but it's very true when we're investing. We don't want to. We need to try and spread and sort of take out that volatility.
Yeah, I think there's the diversification is a key. I think it's something we always talk about, but it's just trying to understand there's lots within your portfolio, lots of good equity firms that have long term, but actually we're not just investing in equities. Depending on your risk, there is other areas.
Correct,
but what I would say, just plug away at the morning market videos. There's some good content that's come from there over the last year and a half.
I think as well.
Been doing them.
Last Friday's podcast with Mark and Jeff on. That's a really good watch if you want to understand how TPI's approach is to the portfolios.
Yeah, great.
I think we touching on that point there. Really, I think one of the things that we get quite a lot as advisors is should I be de-risking the investments? What should I be doing in this sort of situation? Well, I mean, if you look back to COVID, it's a prime example. Really, we had clients who did de-risk when the markets were dropping like they did now, and the problem is it's quite easy to de-risk, but the issue is then coming back into the market and trying to time that again. Trying to time the market is something that you leave to the fund managers, who are the professionals. You just think about your long-term goals and objectives really with this.
Yeah. And you make a valuable point. So if we're just kind of going at the topic now, which is when do I need financial advice? And there's a valid point of, if you have got some uncertainty where you want to talk about your investments, then we're here. You guys have been doing calls for the last sort of 3 to 4 months of people that just want to understand a little bit more about what we're doing with their investments. So I think that's a valid point, is to bring that in. that we're available here. Speak to your advisor or speak to the team. We're here to talk and sort of talk to you about.
We've got. I mean, if you're talking about true potential, we've got a wide range of investing options. You can speak to a financial advisor such as Tom or Helen. We've got a lot of self-invest where you can go on to the website and put some money into an ISA or set up maybe it's just a regular direct debit of £50 or £100 a month. And you're thinking, well, I'm right at the start of the investment journey. I'm going to put £50 or £100 in them. I maybe don't want to speak to an advisor at that early stage. But then as my pot starts to grow, as I think about a goal, I think about what I want to do with that money, then you've got financial advisors on hand who you can speak to.
Well, let's split this in the point of when you need a financial advice and when you potentially don't. So we'll start off, Helen, if we can talk a little bit about people that are just coming into their investment journey in terms of potentially the younger population, but could be the older, where they're looking to save for a specific goal. How we just approach that with a client?
Yeah, so I think the investment journey kind of starts off as early as maybe when you're 18 years old, or maybe when you're finishing university, you're thinking about moving out, buying a house, so it kind of starts there really, and it progresses. And I think it's really about understanding what your goal is. I think Neil touched on it earlier when he was saying, actually, if you're looking to invest for the short term, then actually that might not be the right option for you investing. It's more sort of about establishing as early as possible what your long-term goals are with the funds. And then, of course, as time goes on, things change, and then sort of receiving that financial advice and advisor is there to give you that support and support you in making those decisions. And, they ask you those questions that you might not have even thought of yourself, so it's sort of starting from that point.
And I think I talked to the likes of Earl and others and even David who've been in the industry for many years, and the concept of when you approach initial client about saving for the first time, nothing's really changed in terms of when do you if we're just talking about retirement as an option, when do you want to retire, how much do you need by that retirement, and then you kind of then come up with like a monthly amount that you can afford to pay, and that it used to be on a bit of paper, it's now available on the website. I think that's something that you would do, Tom.
I think go on,
I was going to say, just in relation to the sort of starting off at our sort of age, and yours age as well. Not Neil's.
Are you classing me in your category now, where you usually say I'm not?
But no, I mean, just in relation to that, I mean, I think you probably don't need as much advice at that age. The key things here is making sure you're in a good fund, and then you're in the right products as well, and also just looking at what your disposable income is. Just looking at that every month, and I think more and more people have like sort of bonus pay now, and because of that we've got that impulse save feature, which is a great feature for that. But it really is just about getting yourself on a good footing. I mean, I think something that I said before in the last podcast was just about if you're younger, you can maybe take on a little bit more risk as well. Obviously, go through a risk tolerance questionnaire with your advisor, but you've got a longer time period, especially for pension.
And you can really ring fence funds as well. You don't. It doesn't have to be sort of a one solution fits all. You might have some for your retirement plan and some for your house savings and all of those things. So
different risk profiles as well. I mean, like for instance, you might be like for a house, you might have a low risk profile because you've got a shorter time horizon. Whereas for a pension, you can just you've got 35 years there to put in some high risk.
I think it's currently 55 going to 57, 58 could be higher for when we get there. You've got 20-30 years potentially at that age. And I think just to plug in there as well, we're talking about the ability to use some of your sort of disposable income to put away in the product, but actually the majority of UK individuals now have an auto enrollment pension where they're enrolled in, so it's worth looking at. You probably, a lot of people miss that. I speak to friends to say, if I've got a pension, say, well, I've got this thing that's on my pay slip and I think it's coming out, but actually that can help. But open your contributions on your pension at that age is, typically a lot of firms will match if you are open contributions. It's worth exploring how much are you paying in, because actually it's quite, especially the way I treat my pension is that I take it off before I start, so I don't see that as effectively a payment into my salary.
We treat it as a bill.
Yeah, exactly. That's probably the better word. Yeah.
I mean, and a good point what Helen said before is when you're speaking to a financial advisor and you're doing probably the most basic thing, which is when you're completing the fact find, is your income and your expenditure. It really makes people think, because if you look at your expenditure nowadays, I mean, I had a look at my bank the other day and it was like Disney Plus, Netflix going out, and Sainsbury's here and Sainsbury's there, and you're thinking, God, am I spending that much on shopping, on fuel, on everything? And it really makes you think well, actually, how much can I afford to put away into my savings?
But like you said there, Jamie, if you actually do that before it comes into your bank account, it's a lot easier. Like I've upped my pension contributions now, and when you actually do projections on that, even upping it by a couple of percent, is, it's nearly hundreds of thousands by the time someone like me gets to the sort of pension age.
Great point there, actually. So Helen, within the technology, you can do that, can't you? Where you put your percentage in, and there's a graph. Is that right?
Yeah, you're right. So there's like goal settings which you can play about with. You can put in what your salary is, how much you can afford to put in, and then it sort of gives you those like lovely projection graphs of how much it might be worth by that point. And they're quite conservative sort of growth values. There's no limit to that. It could be higher, of course. So as well.
I think the key thing about starting early and saving regular is that compounding effect.
Yeah, 100%.
It makes a huge difference over the long term. So I think that's that category, which is that's how you get started and what can be available. I think there's some good points there, which is actually you might need just someone to get you on your journey. You might just need a little bit of guidance. You don't necessarily need advice at that point, but you might just need a little bit of guidance to get you on that regular savings journey. So if we kind of then go into the middle, which is what we would class as accumulation, so people saving or getting to that point of having pots and saving and getting towards that retirement. Tom, I'll go to you. How do you approach that with client? What are the options there when we're discussing that?
Well, I think one of the things here is, especially pensions, I think unfortunately pension contributions is overly complicated. And I think that's a certain area that you definitely need a financial advisor just to help you out.
I think to add to that, Tom, we've all had to take exams to understand it.
Yeah.
So I think that's a valid point for a UK consumer. They've made so many changes to pensions over the period of time, and I know we've got pension freedoms now, but if your pension started before this date, these are the rules, and if you've got a defined pension, final salary pension, these are the rules. It's really, really complicated.
I mean, if you look at the different types of pension there is as well, there's so many different types of pension. There's like SASs, there's SIPs, there's stakeholder pension, and they're just the S's, so there's plenty of them. But from our side of things, I think really pension contributions is a really good thing to do. I mean, especially if you're starting to, say your 30s and 40s and 50s, where you might be pushing in that higher rate tax band, putting money into your pension can actually reduce your adjusted income and actually bring down your income tax side of things as well, because you'll get that 20% uplift when you put the money into your pension from, the provider like us. And then you'll also, reduce your tax bands as well if you're a higher rate tax payer, and just helping to sort of reduce the tax side of things as well, which is a really good thing to do.
That's a good point, because it helps from a bit of a tax relief point of view. But if you are a higher rate taxpayer, that additional help of you're getting.
Well, it's a great way to beat inflation, isn't it?
Yeah.
It's a great way to beat inflation. Why not get a 20% uplift and then a potential another higher amount from the government as to the current market? So we always advise to put it in pension to maximise the tax.
It's the growth that you're going to get over that period as well.
On the tax relief.
On the tax relief.
Correct.
This is a two-pronged approach.
Especially as well, if you're earning between 100 and 125,000, these are there's not many people who are doing that, but there is certain people who are doing that. You lose your personal allowance between that 125,000 140 effectively. So for every £2 you go over, you lose your personal allowance by £1. Now that's like an effective rate of 60%. So for those sort of people, if you're fortunate enough to be in that sort of position, really making pension contributions is the best thing you can possibly do, to be honest, in that situation. Obviously within your personal your annual allowances.
And also you've got things like carried forward that comes into play as well, which can be really complex, and I think that's when good financial advice really comes into play, because we can help you figure out exactly how much you can invest.
So explain that a little bit more to me, Helen. So carry forward, what is that? How do clients benefit from carry forward?
Yes, so if you have contributed less into your pension in previous tax years, you can carry those forward into the current tax year. I won't go into all the bits and bobs about it, but but there is certain limitations on how much you can invest, and actually if you over invest into your pension, it can have tax implications as well. So trying to figure that out, especially if you are a higher earner, is really important, because then of course you still get the tax relief.
And I think the most important bit out of that, which is what Helen said, is can be quite complex to understand. So speak to a financial advisor.
So if you've got a pension or investment, if you've got a pension and you've got some spare income, or you actually want to save in your pension, you want to view your options, speak to us. That's what we're here for. We want to give you guidance to do it because the pension might not be the right product.
Well, just coming on to that there, you want to quite a nice mix of pensions and ISAs, because that then sets you up for the decumulation phase. Because with pensions, you can obviously, when you withdraw from them, you can use your personal allowance and take up to your 12,570 with taxable income. Well, if you've got an ISA there in the background as well, you can actually withdraw from that completely tax-free. So that just means that the whole income that you're bringing in the accumulation phase is effectively all tax-free, and that's a really good way of trying to manage your investments. And again, why it's good to have an advisor who can say, look, you're probably a little bit overweight in pensions here, let's maybe start investing in an ISA.
Yeah.
And there is limits you can go in pensions as well, and I know there's different types of clients that listen to our podcast, but there is a lifetime allowance where there's tax implications if you put too much in. So it's one said, when you're starting to get to that limit, that's when you should be speaking to your own advisor. And you find a lot of employers, when you start to get that limit in a defined benefit situation, will tell you to and sort of give you a sort of bit of guidance to go and speak to an advisor.
Yeah,
so please use us for that type of thing as well.
Yeah, we obviously deal with lifetime allowance issues quite frequently within the team, where clients have got obviously larger pension pots, and typically they may have come from a defined benefit background. A lot of people obviously still keep their defined benefits, but a lot of them do come over where it's obviously typically right for them to do so. So that gets quite technical. And you can have protected amounts as well. So it's always wise to speak to the one on the team.
Yeah, because if you do the wrong thing, you can lose some of these protections as well.
Correct.
Which we know. Okay then, so let's move into the accumulation. So people that are retired and starting to take funds. Neil, I'll pass this one to you. Where does the advice element of giving financially become important at that point?
Well, obviously I run the central advice team, and I look at the stats of the calls that come in and the appointments that Tom and Helen and the rest of the team have, and probably from a percentage point of view, about 33% of our calls are drawdown. People going into the decumulation phase. So it's people who have got their pension pots, who are maybe 55 or over, who want to start taking the benefits from that pot. And that's what really that's when you probably need to start speaking to an advisor. And
I think it's worth mentioning at this point, because we had this discussion yesterday of the misconception of people still thinking that they have to take their full 25% of their pension.
My mum's included on that. She asked me when she retired, she said, oh well, I'm obviously going to take my 25% tax free, and I just said, why? And she was like, well, because I have to. And I said, no, you don't. And it's a big misconception. The most important thing is speaking to an advisor, because if you don't need that 25% tax-free cash amount and you do take it, it can have quite a detrimental impact on the income potentially in the future on your pension pot, and what realistically is going to be till the rest of your life.
Is there any, we're in a market where, as I said, it's a bit of a bubbly market at the minute. So, when we're talking about taking your money at this point in time out of your pension accumulation, is the clients you're talking to that are asking, should I reduce what I'm taking out to take this effect from my pension?
It's a good point, because obviously when you do that, say the markets are low and you, for instance, took a big lump sum out like your tax-free cash, you come to different types of risk there. So you've got sequencing and reverse pound cost averaging risk that you come into play with. So if you can avoid it in times of when the markets are low, it is certainly beneficial to do so. How I sort of describe it really is, it's like having a house that's valued at 200,000 and accepting an offer at 180. When you're in cash anything, when the markets are low, you just wouldn't do that normally. You just wait and wait for the sort of house prices to go back up again and then probably sell. So it's sometimes obviously you can't avoid it. You might have bills, etc. where you might have to, but if you can, if it isn't something that you need to do now, it's probably best not to take the money out at this present time.
People will have other assets. They'll have ISAs, they'll have cash in the bank, they'll have their pension, and they should, like Tom's just saying, should I be taking it from there in the current market? Should I be taking it maybe from the cash? So it's always wise to speak to an advisor, and also as well, that pension pot might just be the only thing that they have. So it's having a conversation, maybe it's having an annual review, which we do with clients, to maybe have a look at their income and expenditure, which is good financial planning, and say, what am I paying for that for? And also as well, just to sort of add on that point, the cost of living nowadays, we all know about the high fuel, the high energy costs, council tax has gone up. It's always good, if you're feeling unsure on whether or not you're taking enough out of your pension, or you want to take a little bit more, is to just speak to an advisor and have a review.
I think that's the opposite thing I was going to talk about. So yes, you can reduce in these types of markets, but actually if you are looking at, can I take more out of my pension, is that affordable, is that sustainable? then these are other conversations that you can have at this point with your advisor, who can go, actually, if you take this much out, you're going to erode, or you can actually afford this much more. And I think when we're living in this environment, I'm sure these are questions you're probably getting asked.
Yeah, they are, and I think just the world has changed so much in the past couple of years. The way people are spending their money is very different. So just sitting down and reviewing that is always a good idea. You know, we always say at least once a year, but you know, you can do it a little bit less often or a little bit more often if you want, and just reevaluating everything. It's the ongoing advice when you're in that accumulation phase that is really important.
And just to touch on that there, we can like do cash flow models.
Yeah.
You know, we can show clients, you know, if you know, taking into account your state pension, your defined benefit pensions, we can factor that all in, and we can show you on like a nice, you know, a nice graph to show you what can happen in that sort of situation.
Yeah, and it does go back to a client's goal as well. If they know they want to spend a little bit more in their earlier years of retirement, you know, going on nice holidays, you know, that they might spend a little bit less in the later years. We can plan that out, and of course things will always change, but it's good for a start.
And a lot of people have accumulated a lot more savings in COVID.
Yeah.
You know, there's been a lot of cash saved up, and people want to, you know, cash rates are low. They might think, well, what am I going to do with this money? And that's a constant conversation that we have with people.
Yeah.
Yeah, definitely. And I think, kind of just to finish off on this one area, we should talk about which our job is. I know we've been sort of having these conversations, but if you know, just to really decipher the media that's coming out, you know, there is a lot of uncertainty that's coming out in the media, and we're here to sort of really give you a clear picture of actually what that will mean for your investments on a long-term basis.
Yeah, I mean, we were speaking before earlier on. You switch on your TV and it seems to be all bad news. You see, you know, what's happening. Obviously, the horrible situation in Russia and Ukraine, and you're looking at things getting more expensive. You're feeling it yourself because you're going and you're filling up your car and you're thinking, God, I'm not even getting half a tank out of what I used to get 2 months ago. So it's really important that if you, from an advisory point of view and you're a client point of view, that you pick up the phone and you speak to us. Really important from that point of view, because we can help, but more importantly, we can show how the portfolios work, and how they're invested, and how it is in relation to the market. And the clients that I've been speaking to this week, in a lot of cases, they just want some surety. They just want to speak to somebody, and you know, when we get up, oh really, I didn't understand that's how the portfolios work. I didn't understand sort of what I was invested in. That makes a lot more sense now. Yeah. And it is just about having a conversation.
And it kind of touches on the final point I would like to make, which is about how True Potential offer that hybrid advice model, which is technology and information alongside an expert.
Yeah.
So being able to log onto your website, we deliberately are incredibly transparent in terms of, you might ask the question in terms of, you get daily valuations. Well, why, if it's a long-term investment? Well, actually, it's your money, and you should be able to see your information when you need it.
Yeah.
So we deliberately make, you know, the client sites and the apps to be incredibly clear in terms of, this is what your pension's worth today. This is the trend. These are the percentage increases or decreases. And it's just giving you that information. That's part of the hybrid advice, but that expert's always there to speak to and sort of really guide you along, because this is a lot. We're in this together for quite a long time. You know, we talk about investments. On average, you're probably going to be invested for 25, 30 years over your lifetime, probably slightly more. So we're in this for a long time. So you've got to have that information alongside that expert.
Yeah, as well as on the app or, you know, your client site, there is a lot of you know, YouTube videos on there in the morning markets. Where you can get a lot of content from True Potential Investments, and you can understand what's going on in the marketplace, but also what TPI are doing with the portfolios.
I think one of the other good things to come out of sort of the hybrid, you know, advice side of things is things aren't, you know, on paper as much anymore. You know, obviously we do have some clients which, you know, do want to have paper statements, but, you know, one, that's good for the environment, but two, you've got, you know, if you're sort of unorganised, you've got a big file full of, you know, all your different financial sort of situation. With us, you've got it all on your documents page where you can just, you know, easily get to. And I mean, I think we've been, you know, in the financial press as sort of leading the way in terms of that sort of paperless revolution, really. And I think it is quite a good thing, having everything in one place. You know, you just log on. That's all you've got to do. You don't have to get your big folder out and look, you know, and sieve through everything. You've just got it all there. And we can help you and guide you through to the right documents and all of that sort of stuff, which the team can do.
I remember showing, I've been in True Potential for 15 years now, and I remember showing our first app to clients, to end advisors, and it was the time where the iPhone had just come out, and so the smartphones was like wasn't really a thing known. You was it not get 3310? You probably do you have a 3310?
No.
You're a bit too young
I
for
was
that.
too young.
Yeah,
Yeah, it's
you know,
BlackBerry for me.
Yeah, it was a BlackBerry, but it was at that time, and it was kind of wow, what's that? In terms of, you know, I'm used to getting a paper statement. Now I can log on this thing called a smartphone and click, and it has revolutionised. But now, if you speak to a client, one of the first questions you get asked is, how do I log in to see my investments? And I think that's, you know, we're really important. It's one of our biggest focuses here.
I think as well, from a resources point of view, it's really important to point out that we do have a huge customer care team who will really help every client on logging in and using the client site. We do a lot of demos with clients to show them the different areas of the app or the website.
Yeah.
And I think just the messaging functionality as well. Like, there's nothing worse than only being able to call someone 9 till 5 when you're at work.
Yeah.
So being able to message someone and knowing someone will come back is really helpful.
Yeah, well, we're here. I think the message is, we're here, you've got that information, but we're here for you when you need to discuss and talk these through. I think, you know, we're all in the same situation. Everyone in this room has money in the same portfolios as our clients. Like, if you're in the aggressive portfolio, that's exactly where my money is.
Yeah, me too.
So it's worth just mentioning. We kind of live this with our clients. You know, I think it's a really important thing here that people are aware. Every penny of my money, my pension, my ISAs, etc., are sitting in the same true potential portfolios as I recommend to clients.
Yeah,
definitely.
Okay, well let's summarise. So I think the set a goal. So your new savers, set a goal. Regular saving, benefit from compound averaging.
Interesting.
Close enough.
So compounding is obviously an important thing. You know, I think the key for us is what we said across the accumulation to accumulation is there will be points in that journey that you need an advisor to help and educate you, or just clarify what you may already know. And I think we're here for you. Your advisor here for you, and that's the point that, you know, pensions can be complicated. That slight wrong decision could cost. It's worth speaking to. And I think the key area that we really want to discuss is that hybrid advice model, which is having access to your information and being able to
best of both worlds.
Totally best of both worlds. You always want to see a face behind the technology.
Maybe it's not mine, but
well, Ben, your face is on quite a lot of the technology at the minute.
So is yours, Tom, actually.
The people will probably notice in the annual review when everyone clicks on the link to view it,
No, it's
I think
my side chin.
you're in it. Are you in it, Neil? I don't know.
I think I am. Yeah,
I think you might be.
once. Yeah,
I wasn't good looking enough.
Not me either, so don't worry.
To be in that, but right, we'll finish off in typical podcast style, and we'll start off with you, Neil. What you doing this weekend?
I haven't got any plans actually, and I'm not going to make anything up.
No.
But I had a guilty treat of fish and chips last night, which isn't a good thing to do when you're in training for the Great North Run.
Oh.
But I managed a 5 miler this week and a 13 miler at Great North Run last week. So I think I'll do about 7 or 8 miles this weekend. Yeah, so exercise weekend. Exercise weekend.
So Neil's running at the fish and chip shop.
Yeah.
And over to you, Tom.
I'm going for a few drinks with a few advisors tonight.
That'll be exciting.
Oh yeah, it will be.
Yeah,
I'm doing another
very
really
exciting.
very advisor thing. I'm going to try and play some golf. I think over the weekend
wow.
as well, which couldn't sound
How
more.
old are you?
I know. I'm not telling you.
But no, and you, Helen?
Well, unfortunately, going to the pub is off the
Yeah.
cards for me at the moment. So we've actually just had to buy a new family-friendly car, so I need to learn how to drive that at the weekend. Very exciting
What
times.
kind of car?
I thought you were going to say what kind of baby there.
No.
It's a Volvo black one.
So it's
no idea.
So it's definitely
She's gone full electric.
Yes.
Have you?
Full electric. Yep.
Interesting.
Yeah.
Yeah, so
we'll have
very
to-
exciting times.
Yeah, we'll have to have a look at that when it comes in.
Yeah, I was going. So that's something
Yes.
new you've done this week. You're going to be you having a new car.
Yes,
It's not quite yet, so
Yeah, not quite.
don't wallpaper it. And try not to. I think I don't know what I'm doing this weekend. I think I've.
You used to be boring, aren't you?
I know we are.
I was boring last
I was
time.
planning on doing some running because Neil and I are both doing the Great North Run, but.
Yeah.
Well, competition there,
There's
is
definitely
it?
competition. He'll definitely be me.
There's no
He'll
competition,
definitely
yeah,
be me.
I've got a few years.
I was just gonna say as well. It's supposed to be really good weather this weekend, so hopefully a trip into Durham or something.
Yeah. Everyone laughs at me when they talk about going to the pub, Tom. And I went on holiday just a few weeks ago, as people know, and I ended up with 2 new clients because Kai come asking us about his pensions. So, do you know when we talk about needing financial advice?
Yeah.
For some reason, people can spot me a mile away. I said it used to be if you told them you were a pension, your pension advisor would be nowhere near. Now everyone wants to be.
I think the giveaway was you were wearing your gilet by the pool.
Yeah.
He's just got loads of different gilets.
I actually had the
On every day.
TP scarf, TP gilet.
Yeah.
Maybe that was what it was. I don't
We
know.
just need TP swimming trunks now.
Yeah.
You've got it fully kitted out.
We don't want to see
I'm
that.
not, yeah. On that note, you definitely don't want to see that. Great. Thank you, everyone. Great, really great, informative session today. I think that the message is really is we're here if you need us. We really are, and we love speaking to our clients. So thanks once again, and thank you everyone for watching. Please click subscribe if you like this. If you'd like to see more of this content. Thank you very much.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.